Hello, everyone. This is Dave Ige, and we're grateful that you're here on our webinar today. Today we have a special lender, Finance Factors, and they're going to hopefully help you solve some problems in regards to loans. But before we do that, we want to thank our platinum sponsors, Accra Lending, Freedom Mortgage, Finance Factors, Bank of Hawaii, Mutual Underwriters, EV, Acosta, Angel Oak, and Champions Funding. We thank them for allowing us to create these webinars for you. We hope that you will get an education of the loans that are out there to help you get loans done in this challenging time. I'm going to turn the time over to my Vice President, Judy. Judy, take it away. Grateful that you're here with us.
Thank you so much, David. Thank you for everyone for allowing us to be here with you today. Thank you for joining the webinar with the Hawaii Association of Mortgage Brokers. And today we've got our platinum sponsor, Finance Factors. With us today is Brian Ware. With Finance Factors, he is the Senior Vice President and Residential Lending Manager. And just as Dave Ige had mentioned, he is here to tell us all about not only who they were, but who they are today. Go ahead, Brian, take it away.
Thank you, Judy. Thank you, David. And thank you, Hamby, for having us today. We are really excited to be here and to talk to you guys a little bit about some of the things that we have been doing at Finance Factors. And I know, a lot of you are familiar with Finance Factors. We have been serving Hawaii's islands for 71 years this year. And, we were founded 71 years ago by 5 families to really address the address the fact that the larger banks were not lending to the minority communities here. And that has really been our mission and our vision for the last 71 years, is to find unique solutions to ensure that the people of Hawaii can continue to stay and have access to capital in Hawaii. And part of that is really evolving and growing who we are. Like we said, we've been around for 70 years. A lot of you guys have dealt with us for a very long time. We've got a very tenured loan officer team. Rory has been with us for over 40 years. Bill, Romeo, they've been with us for a very long time. And I know you guys are very familiar with a lot of the unusual situations that we've done, which is really great in this market and in this time, because the easy, the low-hanging fruit isn't there like it was, for the last couple of years. So we're really going to have to start to dig in and find unique solutions in order for us to be successful in this market. So, that's one of the things that we've always been helpful with. And it's not just the, when I've been here at Finance Factors for 2 years now, and when I got it started with Finance Factors, I went out as much as I could because it was right in the middle of COVID. And I would talk to realtors and brokers and to get an understanding of, who Finance Factors was in their mind. And a lot of consistent feedback that I received is like, oh yeah, Finance Factors, you guys do the weird stuff, right? Yes, we do. Tear down properties, unpermitted structures, condotels. Yes, absolutely, we do the weird stuff. But one of the things that we have been growing and evolving over the last couple years is to be, a solution in more than one area and more than just the weird stuff. And we recently, so I want to walk you through a couple of scenarios where, yes, we're doing outside of the box stuff, but not just the weird stuff. This loan actually is a recent one that came to us the other day from a broker. Their client was actually LP approved. So that's not weird. That's not outside the box. What we're finding success in is, I don't know, I'm sure you guys are paying attention to everything that's going on with Freddie Mac and Fannie Mae. They're really trying to get away from the investor market. So this particular scenario was priced last week. So this is not, these are not current rates. This was priced last week when it came into us. But this was an investor that got approved through LP. So we've got a salaried borrower, good FICO score. He could go conventional financing if he wanted to. However, because of the LLPA pricings that are going on with Freddie Mac right now, our GAP program, our portfolio GAP program, was a much more attractive offer. At 25% down, the interest rate difference was about 0.75% on what he could get through Freddie Mac. And that's saving him, several $100s a month in his monthly payment. So that increases his cap ratio, it lowers his debt service ratio, and really is a solid solution for investors out there right now who are good qualified borrowers, but who don't want to pay that additional LLPAs and additional pricing adjustments that the traditional servicers are doing right now. So that's one way, you can help find and add value to your investor clients that we're doing here at Finance Factors. And it's not just this is a guy that could go anywhere. So I'm going to go through a few of our products and just kind of talk to you about how we've been able to leverage and utilize those. For those who are familiar with Finance Factors, you know that multi-collateral is one of our particular go-to products. I don't think there's anybody else in the island that's really securing more than one property for a transaction. And where we find success with that, we just recently, and they're probably signing right now as we speak, we're closing a loan over at Ho'opili. And it's, they are looking for brokers and lenders to help find them more borrowers because they're not moving the same units that they used to. So this is something that you can throw in your tool bag, maybe go reach out to Ryan and have a discussion with them. This loan came to us from a broker. It was a self-employed borrower, actually a real estate agent, who wanted to buy a new primary residence out of Ho'opili, but they just didn't have the cash, right? And they didn't want to take out additional financing from their properties because they had such low interest rates. Refinanced everything within the last couple of years. Interest rates are somewhere between 2 and 3%. You don't want to do, 3-4 HELOCs in order to gain the capital that you need for the down payment. So they came to us. We secured collateral off of 4 different properties. So you've got the purchase property at Ho'opili. You have their current primary residence that they're retaining is going to turn into an investment property, and 2 additional investment properties. We were able to securitize the collateral across all 4 of those properties to get to a point where I believe the loan to value, the total loan to value on the purchase price was 98%, and we could have gone over 100% if there was room in the income ratios. So this is a phenomenal product that we were able to get into a home without having that actual cash to put for a down payment. We also were very liberal in our income calculation. So that's another one of the great things about Finance Factors is, we're not beholden to investors. We do not sell our loans on the secondary market. We lend against our balance sheet, so we can make the decisions that are common sense and are unique to this island and unique to situation to make a common sense decision. So part of the income qualifying for this particular loan was using the projected income from the current primary residence to add into the calculations. So, when you've got that plus the additional multi-collateral, you can see how we've really been able to position ourselves to help this client to get into a property where many of the other banks may not would have been willing to take on that scenario. So this is a really quick slide to show you how multi-collateral works. This is our 2 collaterals, right? We take the combined value, then we divide it by the total outstanding loan amount. In this scenario, we could give over the amount of the purchase price. So that's a lot of opportunity that we've been able to do is not only fully fund a complete purchase, but give additional cash if there needs to be renovations to get the current residence or one of the other investment properties back to marketable status. There's a lot of flexibility and uniqueness in this particular product. So other situations, again, we're talking about outside the box stuff, but we're talking about really, A paper stuff that we're just looking at it differently because, again, we're not beholden to the strict type boxes. of investors. So, let's talk about those second two bullet points: self-employed and investors. That's really where we shine. That's really where we see a lot of flexibility in our lending. Between self-employed borrowers and the combination of self-employed investors, we just closed and funded a loan. I want to say it was just under $2 million last week. And this was, if you've never seen complicated tax returns until you've seen this guy's tax returns. He owned, I want to say, about 5 different LLCs, 2 DBAs within 2 of those LLCs, 5 to 10 properties in a couple of those LLCs. And he did a lot of vacation rentals. And his vacation rentals were in Anaheim, California. So he had themed houses, like he had a Frozen house. He had It's a Small World house, and really great short-term rental themed houses near Disneyland. And he was a very successful business owner. He had another line of business that was healthcare and hospice care, elder care. So he had multiple streams of income coming in. But the problem is his main source of income through those short-term rentals were at Disneyland in California. And we all know what happened during COVID, right? Disneyland shut down, California shut down. So his properties didn't produce any income for about 18 months. I talked to our underwriter, we talked to our chief credit officer, we put our heads together to find a solution on how we were going to underwrite this file, because the idea, especially when you're an investor, we don't have to follow strict ATR guidelines. We have a lot of flexibility to make a common sense decision. Where sure, his income over 20 and 21 was very light and is actually showing some losses. That doesn't give a full picture of who this individual is and how he's able to own and operate a business. So we were able to look at his full capacity, right, and not count against him those losses for 2020 and 2021 to get a better and really more accurate assessment of his future income. Because that's what we really want to find out when we're taking a look at a file, right? Is, are you going to pay us back? Do you have the capacity to pay us back? And just because the world, had a crazy epidemic time, a state fully shut down, doesn't mean that this individual doesn't have the capacity to pay us back. And we took that and we made a common sense decision on that, and we moved forward. And he got really good pricing too. It went into our prime jumbo pricing, which has been, super competitive, just like the rest of the, the larger banks that are taking in the larger loans. But I promise you, they're not looking at income with the same type of common sense that we're looking forward to it. And again, I want to talk about self-employed too, just not from an investor standpoint, but from, a primary resident standpoint. A lot of times, we deal with professionals who are in a transitionary period of time. So dentists, doctors, CPAs, attorneys, a lot of them find that when they transition from W-2 to 1099, they can see a higher level of net income that they actually bring in, and they can control the way that they pay their taxes. However, Freddie Mac, Fannie Mae, they're going to penalize them for that. They're going to say, okay, you don't have enough time being self-employed that we can count that income for you. We just brought in one scenario of a person who recently moved from W-2 to 1099, and we've already approved somebody else who is, probably on this call, that they know that they can bring in their bar as soon as they get a purchase agreement when switching from W-2 to 1099. And we're putting them in our gap pricing, which, as I just showed you, can have the ability to really beat out a lot of the conventional and other, non-QM pricing that's out right now. Everybody knows we do properties in poor condition. If you're on this call, know that, our big thing is, we're going to appraise as is, or if it's in really bad condition, we're going to take the land value and lend against that loan to value. But again, these are the type of things that we've always been known for. The outside of the box, the quote unquote weird stuff, the properties in poor condition, some of the things that we do, obviously unpermitted improvements, you know, those single family homes that have been walled off and, you know, made into multifamily, you know, legal non-conforming units. We appraise as permitted. We give income as permitted, but we will not penalize you, and we will do those types of loans for you guys. Another one, unusual collateral and zoning. Again, condo hotels. You know, a lot of, especially right now with the legislation making it very difficult to do short-term lending here on this island, a lot of investors are moving more towards the permitted stuff, the condo hotels. And a lot of those are, you know, you'll find some of the other banks in the area don't want to do it if one investor concentration is too high, if it's a lodging unit, there's no kitchen, full kitchen in there, things of that nature. Those are some things that we can do at Finance Factors. I just got a scenario yesterday where a timeshare owns 50% of the units, right? That's not an automatic no for us. We're going to take a deeper look into the condo financials, see if they have, you know, the wherewithal to have some reserves in case this one customer decides to stop paying them. But that's not an immediate no for us, and it looks like we're going to move forward with that request. So just a lot of flexibility when it comes to some of these more unique outside of the box situations. Bridge loans and reverse 1031s exchanges, you know, of course we do those. We're not seeing as much of them in this market because, you know, this market is just not as hyper competitive as it was a year and a half, 2 years ago. But we're still doing a lot of reverse 1031 exchanges for those investors who want to make sure that they don't make sure that they can purchase before they sell their current investment property. Foreign borrowers, we're starting to see that starting to open up a little bit more. A lot of Canadian borrowers looking to move back into Maui. Japanese borrowers starting to come back again. So just again, if you start to see those situations, we do offer foreign borrowers, but it's on improved properties only. No construction or land or anything like that. We rolled this out last summer. It's just our residential DSCR program. For those of you who are not familiar with DSCR, that's debt service coverage ratio program. And we just rolled it out at a really bad time because interest rates went through the roof as soon as we rolled it out. But it's, you know, when the interest rates start to come down and our ratios start to look better on the investor products, this is a great solution for those investors with super complicated tax returns where we may not be able to extrapolate the income that we're looking for. So that's, you know, that's who we are, guys. That's who we've always been. We truly understand how to lend in this state. We understand unique opportunities. We understand unique credit situations. You know, we've some of the things that we see when it comes to income, especially on investors, you'd be surprised how we look at it, because it's a full picture thing. Is, you know, one of the things that I want to leave you with Finance Factors is, you know, a lot of what really makes us unique is we look for a way to say yes. And a lot of times that gets us a bad reputation is, oh, you know, Finance Factors, they take a long time, or, you know, they take for a long time to close their loan. Well, we can give you a decision back very quickly, but it's going to be just like the other banks, right? And if you send us something that's cut and dry, like, you know, that scenario I gave you at the beginning, you know, it's a LP approved type of loan, we committed to closing that loan in 35 days. But if we have to dig deeper, if we have to take, you know, another angle approach to looking at someone's income, request additional documents, sometimes that takes a little bit longer. And for those types of loans, there's going to be a little bit of a longer cycle time, right? The loan I just talked about at Ho'opili with the 4 additional collaterals, you know, that loan originally came to us with a 30-day close time. You know, and I chuckled when it came in because there's just no way we're going to, you know, be able to be creative with your income calculations, get 4 appraisals. One of those appraisals we needed to project future income. You know, that's just not going to happen. However, you know, we're competing really well right now in the gap space, in the jumbo arm space. You know, if you've got a very qualified borrower, they check all the boxes, they're in the, you know, they're inside the box. we're going to get that done just as quick as anybody else. So, we can, I saw something on Instagram the other day, and it was the guy said, I can do something well, I can do something fast, or I can do something cheap. And you can choose two out of the three, and that's what you're going to get. And we're very similar, right? We can do it fast, we can do it easy underwriting, or we can be creative. But we can only do two of the three at the same time. So if you want us to be creative, understand to set those expectations up front, because we're going to find a way if there's a way to move forward. But if it's something that, you're currently seeing that we're winning out on interest rates in the jumbo space and the gap space, you need a quicker close time. Don't hesitate to say, hey, I need this done quickly, because we do have the capacity to push that through as well. So that is the end of my presentation. These are our loan officers right now. Bill Grant and his son Josh Grant now with us. Greg Ravello, which you guys may have known, is past Hamby president. Romeo Anacon. Kim Norton is our officer out on Kauai. And of course, everybody knows, the non-QM specialist, Rory Matsumoto, one of the most educated guys in this space. So that is all I have. I'd like to open up the floor now to any questions, any feedback that you guys may have for me.
Awesome. Thank you so much, Brian. So let's give it a few moments for the questions to come in. So everyone that's in attendance today, feel free to type your questions into the chat box for Brian. Dave, did you want to say something?
Yeah, I just want to say that I don't know if you guys caught that multi-collateralization loan programs are very good to have. If you got somebody that needs to borrow money and they have other properties and they don't know how to tap that equity, that is a great way to do it. I've done those on several occasions on people having properties, but they just don't know how to tap that. So when you talk to your clients, you need to be very thorough. You need to find out, well, what do you want to do? Well, I got this one property. How many do you have? Well, I've got 4. I've got 5. Do you have any equity in those? Well, this one here is worth 800,000. I only owe 300. There's a lot of things like that when you talk to your clients you need to get, because those are resources that you possibly could use. And then you just bring those over to finance factors and let them say, okay, with this, we possibly could do that. They'll help you try to structure the transaction. And I think that's what Brian is saying is they can do it for you, but it may take some time. They're going to look at all the different angles to see how they can do that for you. So, but you have to gather the good facts. You have to get as much as you can from your borrowers and your investors or whoever you're dealing with to basically put together a good picture for Brian and finance factors so that they can say, hey, we think we can do this. And that's what it's all about. Right now, it's tougher to get your A paper loans done. So you got to think outside that box. And that's where finance factors is. They're outside that box. And everybody who knows me knows I'm always outside the box. A lot of times people have to throw me in a box, and I'm just the outside of the box kind of guy. So I'm hoping that you guys understand that. It's so important. You got to have more bullets in your holster, more arrows in your quiver if you're going to be able to basically meet the requirements or the expectations of your borrowers, whether they're purchasing or whether they're refinancing. Look at that. And Brian's got some good programs there. I hope that you guys will take advantage of that. And that's my 2 cents. And I agree with what
Thanks.
Brian says on some of those loans. Tell you, I love those kind of loans.
Thanks, David. Thank you for saying that. And I also do want to let you guys know, I've sat down with a few of you as well. We have been here for 71 years, but we don't want to sit and rest in the fact that, we have that level of longevity. I've been sitting down with some of you because I want to understand what you're seeing out in the market and where those gaps are. And instead of just trying to present you a product to, fit a solution that, is in my mind where I think we can be more, we can get more money. I want to see where the problems are, and we at Finance Factors want to see where the gaps are, where we can continue to be, that stopgap for you, in the state of Hawaii.
And I really like, thank you, Brian. And what I really like also that you mentioned, Brian, was about looking at non-QM, looking at your gap pricing as a solution to what is happening currently in the market. I mean, all of us felt it the last couple of weeks, which is we had a really great run on rates. We were quoting up a storm. And then now, of course, this week when it's been time to lock, rates are up, right? So having this opportunity, the way that you would just describe, looking at a non-QM product with lesser add-ons and lesser LLPAs that may lead to an overall better scenario for the client. And then that way they can show more value to their customers. I think that's amazing.
100%. And in our 7 and 10-year arms, we underwrite to intro rate as well, so not fully indexed. So you can find that opportunity to where you're finding that ability to qualify more borrowers.
And I do have a question. One of the things that is always on my mind, and I know that it's on everyone else's mind as well, is short-term rentals and condotels, which I have been very successful in working with finance factors. In fact, I think you helped me close a lodging unit. For those that don't know what a lodging unit is, it is the short-term rental condotel that definitely does not fit into any of the condotel boxes. It is a true hotel room. So it doesn't have the full kitchen with the 4 burners and the full-size appliances and some of the things that the other lenders are looking for. Brian, why don't you talk to us a little bit about condotels and how you guys are able to finance lodging units and some of the differences for those on the call today?
Sure. So, I think you did a very good job explaining the difference between the two of them, right? Condotels, they have to be, they're much more of an apartment type of unit. They can be lived in, but they also have a front desk that manages the short-term rental. Lodging units are really, most of them are just converted hotels. They were never intended to be long-term living situations. But they still offer a phenomenal opportunity for investors who are in the short-term rental market. And we understand that. So we understand the value in those types of properties. And we allow them without any, full kitchen, really with just a, space with a sink and a microwave, that can be considered a lodging unit. And we have no problem underwriting and approving those loans. The big thing to think about when you're coming with any kind of condotel, lodging unit, the difference between that and a full condo for our sake is that we do not want to use any of the subject rental for underwriting the loan. So that individual has to be able to carry that payment without using the rental income from that particular unit. However, if they own another short-term rental, they own another condotel, and they're paying their taxes on the rental income coming from that, we will consider that for income. It's just the subject property only we will not consider the income for.
That's great, Brian. I think that that's really good intel. A lot of times when folks are buying an investment property, they automatically assume that they can use the investment property from the investment income from the subject property to help them qualify. So knowing that they cannot use that they've got to carry it, because as we all know, COVID could happen tomorrow, right? And they could all go dark again, and there could be no renters. And some of those same things that occurred a couple of years ago could occur again. And if that were the case, the income would not be there. So being able to carry that cost on their own and not being able to use it to qualify on the subject property is really important. We've got a question in the chat box here asking, can you please go back to the slide on the non-permitted square footage chopped up multi-dwellings? And maybe we could even talk about that a little bit more, Brian. I know that
that was this slide here?
Unpermitted improvements, I believe, is what they're referring to. And maybe you could talk about that a little bit more as well, because obviously here in Hawaii, we've got a lot of folks that have gone in, they have boarded up one side of the home, they've created their separate units, added additional kitchens. In that space, do you allow them to use the rental income from those other kind of illegal or non-conforming units?
again, not as the subject property. So, as we show in the appraisal, we're going to appraise as permitted, and we'll take the income as permitted. So, we'll order the appraisal. We'll take the income as permitted. So if they've got it sectioned off to where they have, 3 units, but it's a single family home, we'll take the income from the single family home, and allow that for income qualification. But we will not allow, the income from the additional units. Now, if they already have a property that they have unpermitted improvements on, and they are receiving income from 3 units, even though the property is a single family home, and they're paying taxes on it, we will accept that income. Even more so, we can take that property as additional collateral if we're needing the help from a liquidity standpoint to meet our down payment.
Okay, that's great. Now, what about this as a spin? Let's say that instead of it being a purchase, it's a refinance, and they have been filing the border income or additional income from those units on their tax return. So it is substantiated, and they have been collecting it for a couple of years. In that case, do you accept
Then we will take that income. Yes.
Wow.
Yeah.
That's
the
awesome.
important thing is that we can verify that income is coming in. But when it comes to any types of projected income, we want to take the most conservative approach.
Awesome. All right, while we wait for some more questions to come in, let's get to know you a little bit, Brian. So what do you like to do for fun when you are not working?
Oh, wow. That's a great question. Lately, I've picked up golf. It's been as frustrating as it's been fun. If there's any of the Hamby golf members on the call, they know I'm terrible. But I guess, to be honest with you, that's what makes it fun for me, is I know I'll never master it. And there's always something that I can learn through going through the process. And that's me. That's, I enjoy learning a lot. My wife is tired of me picking up a new hobby every year. I've learned, gardening. I worked at a cigar lounge for a little bit as a bartender. I've got a wealth of knowledge when it comes to cigars and whiskeys. I'm always looking for different ways to prepare food, make food. I've got all sorts of weird, wild kitchen equipment, as well as cocktails. So, but yeah, I learn. That's what's fun for me, during my free time. And I'm finishing up my MBA this semester as well.
Wow, congratulations, Brian. Sounds like you are definitely busy. And since you brought up golf, I'll take this opportunity to talk a little bit about, and you brought up food as well. So, so remember everyone, here at Hamby, we have our website, hamby.org. And if you go on our website, you will see our events calendar. And tomorrow we have our chili cook-off. So tomorrow at Ferguson's Pub, starting at 5 p.m., we've got a number of groups coming together to cook chili for you guys. So please buy your tickets, come on down, Ferguson's downtown at 5 p.m. We've got some appraiser judges. We've got the Board of Realtors. Dave, do you want to jump in here? We've got the Board of Realtors coming in to be judges. It's going to be a great networking event with appraisers, real estate agent, lenders, and of course, it's going to be at one of our favorite hot spots right downtown, which is Ferguson's on Bishop Street. Tell us a little bit about it, Dave. Oh, you're on mute.
Can you guys hear me now? Okay. So tomorrow is our I'm going to call it like an opening social for Hamby. And so we really want you to be out there. Come on out, have some chili. We got some great judges. We have 3 judges, all tied into our industry. We got the president of HBR, and we got the appraisal association coming out, and Brian's going to be one of our judges. So we got a lender, we've got appraiser, and we've got the head of the realtors here in Honolulu. And I wanted to let you know, Judy and I, and Brian, we met with the Board of Realtors presidents and CEO, and they all want to really get to know loan officers. They really do. They know that a loan as part of their transaction, but they really don't know us. And our meeting with them was very productive. They want us to network with them. And that's a great time to invite one of your realtors to come on out and enjoy the festivities tomorrow night. Can't be any better, especially in today's market. You need to have a strong, close network of people you work with. And people only work with people they trust and they like. It just comes down to that. If they like you, great. If they trust you, even the better. All right. So nobody's going to know you. Nobody's going to like you if they don't know you. So I would pick up a realtor and said, hey, we're having a chili cook-off tomorrow night. Why don't you come? My treat. And start networking with some of your best realtors and let them know that even though it's slow, it's still important to basically do things together and keep those ties tied together. Because when the market changes or when they come across a challenging situation, you're going to be there for them and Brian's going to be there for you. So that's what you got to look forward to. Tomorrow night, be at Ferguson's, 5 o'clock. I think we're going to have good food, got some prizes, and I think we're going to have a great time. So I hope to see all of you guys there to help us celebrate the opening social for Hamby. And we want you to look forward to other socials. Our membership committee is also looking at planning other socials throughout the year. So we hope that you'll take advantage of that and invite some of your realtor friends, right? Invite some, one of the groups of people that we don't give a lot of thanks to is our escrow people. They're the behind the scenes kind of putting everything together, but it's a good way to say thank you to them too for all they do. Appraisers, get your appraiser, that you use and have them come on out. I think it's all important. It ties us all together. We're all in the same canoe. We just gotta paddle at the same speed, especially in this kind of market right now. So that's all I gotta say. See you tomorrow. Chili and rice. I'm a chili and rice guy. They got chili and cornbread. That sounds good too, but I'm a chili and rice guy. And you could probably put a scoop of mac salad off to the side. So
sounds fantastic, Dave. Thank you for that. And we're definitely looking forward to, Brian, you being a judge. And in addition to that, for Hamby, on hamby.org, our events calendar, we've also got coming up the Hamby food drive with the food bank, and we'll be packing and volunteering down there March 18. And then calling all members. So this is a great year. COVID is over. This is a great year to get back into networking, get back into the community, give back to the community in which we derive our income. And at Hamby, we've got opportunities for you to volunteer. We've got our membership committee, which Brian is a part of. We've got our technology committee. We've got webinar and education. We've got events and conference, if you love being part of events and helping with the conferences and seminars. The legislative committee, and of course, golf that Brian had mentioned. We've got an amazing Hamby golf events and group as well. So please reach out to us. Let us know what your interests are. Join us in our cause here, bringing more service to the community in which we derive our income. Just really looking forward to this year. Anybody have anything else to say? Any questions coming in? Anyone that you'd like to present?
I do have another question. I have a question for Brian. Brian, if you mentioned at the beginning of the program that somebody had an LP approved, eligible, if they bring that in, is that going to help speed up the underwriting process with you in terms of maybe a program that you folks have that's not your Fannie Freddie? Are those findings important to you as well? If like you basically change loan programs because of those fees, for that client was less, is that helpful to you?
It's helpful for us in the fact that we know we have an inside the box client. That's what's helpful for us. We manually underwrite every loan that you give to us. We do not put it through a desktop underwriter because there's so many limitations to what they'll allow. But if you know that you have a borrower that is perfectly fine going through LP, just let us know that so we know how to prioritize that and we can push it through super quickly. But but the finding itself is not a huge thing for us because we do manually underwrite everything.
So then I guess what's really good is to have the loan officer basically write a good cover letter explaining a lot of the situation on the loan. So that way it makes it so the underwriter has a pretty good picture of what they're looking at.
Dave, yes, absolutely, 100% every time. And I think that's just one of the things that we should just get good at in our industry, whether you're working with a difficult file or a very easy file. You know, you've got to sell that. We're salespeople. Every single one of us are salespeople, and we're not just selling to our referral partners and our clients. We're selling to the underwriters. And part of that, delivering a great sales package, is putting that good cover letter up front and explaining, you know, wholeheartedly, hey, this is what's going on. You know, because a lot of times we deal with very difficult situations, and maybe you talk to me about it, but, you know, I don't discuss every single file with my underwriter if I don't have to. So the more information that you put on that upfront, like say, hey, you know, where the client is living in the ADU and renting out the primary residence, right? You know, just give us that additional information, so we don't have to try to figure out, you know, our underwriters are already trying to put the puzzle pieces together right there, and they do a phenomenal job with what they do. But anything that you can do to help and make the process a, you know, more streamlined experience, absolutely. The cleaner your file comes in up front, the faster it goes out the door. We're no
Great.
different than anybody else with that. Thank you. It was a great question.
And in respect to that, if they were to move their file over to you, do you take assigned appraisals or do they need to order a new appraisal?
Yeah, so that's a great question. It depends if that appraiser is on our approved appraisal list. You can just assign that right over to us. If it's not, we can do what we call a desk review, where we can have one of our approved appraisers take a look at that appraisal. It's a little bit less money and it can be quicker, so that we can take that appraisal that's already been done.
Awesome. We've got another question that came in for you, Brian. It's coming in from David Fulmer. Second, so it says single family residence is chopped up to 3. And then second is permitted non-conforming. So rental income on single family residence as a 1 unit, then legal non-conforming ADU.
Okay, let me see if I gathered all of that. So
yeah, I'll repeat it again.
no, just let me recap it and see if I'm right.
Okay.
So I've got single family resident. We're going to do 3 rentals. The single family is chopped up into 2, and then there's a legal permitted ADU. Freddie actually changed their guidelines to where they will take income on legal permitted ADUs. So we're going to be no different than, we will never be any more constricting than Freddie. So we will take the rental on the ADU. We'll take the as permitted on the single family.
Awesome. Thank you.
Yep.
All right. That looks like the last question here. So what do you think is the most, Brian, while we've got you on and you guys do so many out of the box scenarios, what do you think is the most challenging scenario you've ever seen?
Oh, wow. You know, I'd really have to dig into it. And it depends on what you consider challenging. Because there's a couple of different types of challenging, right? There's challenging to the point where, you know, can I figure out a way to approve this loan? And then there's challenging with, you know, is this a stressful process for everybody, right? And those are 2 different ways of being challenged. And not so the one I want to talk about first is, you know, the loan we're signing today, the 4 units purchased out at Ho'opili. You know, that was a challenging loan, but what made it a challenging process was the lack of upfront expectations. So, you know, it came into us Christmas Eve with a 30-day closing. So, you know, we have 4 properties that we have to appraise. One of those properties, we have to wait till the appraisal comes back to calculate our income. And we have to take a look at self-employed income that we need to figure out all the angles from, because it's income that's coming from a industry in a declining market. So all of that's not going to happen in 30 days. Had that come in with the 60-day contract time, no one would have been stressed out, because we're closing today. That's 60 days later. What made that a very difficult process is the failure to set upfront expectations. So now the builder is concerned. They don't know if their borrower is qualified. You know, they're like, okay, now we're going to charge per diem every day because we said this is going to close the end of January. You know, so there's a lot of stress that comes within that. And not to mention, we're placing a lien on a current primary residence. So that's actually considered a refinance and subject to right of rescission of 3 days. So there's just, and then, and this individual had already had a new renter signed up to come into the house March 1. So there's just, that became very conflicting, is because the expectations weren't set up properly. The process became way more difficult than it ever should have had to be. We easily got that done in 60 days. But it became a very stressful process for, my loan officer, my broker, who sent that over to us, the buyer, who was also the agent, and the builder. I don't think anybody had a good time going through this loan process, and it could have all been, alleviated if we had set the proper expectations up front. So that's that type of challenging. And then again, so what's challenging to me, when it comes to finding a way to approve a loan, I don't really, that doesn't bother me so much, because that's the fun part of what we do, and we've got some really great, really experienced underwriters. We've got an amazing chief credit officer. We have a wonderful president, and we all look at, we all look at from our angles, right? And that's one of the great things about Finance Factors, is we are a very compact organization. I can call the president at, anytime he's not in a meeting. I pop by his office, peek my head in. Same with our chief credit officer. And because we lend against our own balance sheet, we can come and make decisions that other banks may not be able to make, right? We look at the full profile of a request. If my borrower is weak, is my collateral strong? If my collateral was weak, how strong is my borrower? Where's the liquidity there? We can make common sense decisions, especially when it comes to investor properties or investor requests, that allows us to be flexible, and really fit with inside, our credit box and what we're trying to do. I think that's, and we're always looking for additional ways where we may, have, a blind side. Again, I'm not a producer. I'm not like you guys who are in the streets, who are seeing the transactions or having those near misses, who lost their check because, they couldn't get it approved. You guys are the ones that are out there on the streets and seeing those types of scenarios. So, if I ask you to lunch, know that that's the reason why. Is I'm not trying to get your business. I want to know what you're dealing with in the market, so that we can find a way to bring you more and better common sense solutions. And some of the things we've already done, when it comes to lowering our pricing, removing some of the restrictions on, switching from W-2 to 1099. A lot of the things, is that feedback that we've received from you, and where your stop gaps are. Again, qualifying on intro rates from 7 and 10-year ARMs, that came from, conversations that we had with you guys. So, if you're seeing something, I'm always, I love to drink whiskey and grab lunch. So, reach out to me. Let's talk story. Let's figure this out, because in this market, you guys need a partner that's going to help get you to the finish line and to get more clients to the finish line. And Finance Factors wants to be that partner for you.
I want to comment here. As loan officers, I think you can't just be an order taker, like, oh, what kind of loan you really need to delve into your clients as Brian says, the more information you have, the better picture you're going to have in terms of what kind of loan that person might be able to obtain, as well as, holy smokes, this guy's got income from 10 different sources. It's going to take a while to put that together. Now we've got these new loan programs called bank statement loans, and you got to collect bank statements, and you're adding those all up. You got to say, oh, I need to close in 30 days. You need to tell them, hey, it might take a little bit longer than 30 days to get this thing done because your income by self might take us, 15, 20 days just to sort out because you've got 7 or 8 different companies. But that's a loan officer thing. You got to let them know. You got to let your clients know that expectation. And you should, if it's a purchase, let the realtor know those situations. You don't have to go into the detail, but you have to say, hey, their loan is going to be a little bit more complicated than just an A paper loan. And that's where I hope that we as loan officers, you educate your real estate agents that there are different loan programs out there that do they solve a problem? Yes. But could they take longer to get done? Yes, they could. And if you're new to those kind of loan programs, you got to get used to that. So all of those types of things are very important to let your client know that's borrowing the money, as well as the real estate agent, so that everybody understands where everything is and has less stress, as Brian has said, because there's nothing if you want a good review, you definitely don't want your clients being stressed, because either they're not going to give you a review or they're going to give you a bad review and say that was one of the worst experiences I've ever had. We as loan officers never want that. We want people to go in there going, you know what, that was a very pleasant experience. It was like painless. We closed. It was my first home. That's what you want to hear. That's why we're in this business, is to provide excellent service for those people. But you can't do that unless you get all the information, and you somewhat have to look at it. If you've been in this business long enough, what loans are going to be tough and which loans are going to be relatively easy. So hopefully you relay that to your client, and you relay that to a realtor if it's a purchase, because that's all very important to set that expectation, as Brian said.
Couldn't agree more. Thank you, Dave.
Absolutely awesome. And Brian, I know that even though you guys do definitely a deeper dive when it comes to compensating factors, outside of the box lending, talk to us a little bit about the technological changes that you've been making at Finance Factors to kind of give yourselves a lift.
Sure. So many of you may be familiar or not, but we rolled out our third-party originator system this past summer. And it's taken a little bit for us to all kind of get on the same page on what those capabilities are, but we've really opened a lot up to you guys as brokers, where you can, input your entire loan, upload all of the documents, but you can also price, register, and lock your loan yourself. So if you cannot get a hold of, your AE at the time that you need to lock your loan, you can always go back into the system and do that yourself and request it to be locked. So you have a lot more control over that, as well as there's milestone updates. You can see where your loan is at in the process. The conditional loan approvals, they come directly out to you, and then you can upload those conditions, get them signed off as they come in. So that's one of the things that we've been able to do, and some are a little bit faster to adopt that than others. But another thing too is, I think it's a very liberal policy that we have. We release our rates once a week, right? They are good from Friday at 2:01 to the following Friday at 1:59. So, there is plenty of time for you to lock your loan. And, from the volatility midweek, you're never really going to be affected by that. So, it's a really big leg up, in this type of volatile market, that you've got a rate sheet that lasts for a week. So if you talk to a borrower on Monday and they want to kick the can around until Thursday, Friday morning, you have that ability to make sure that you're still quoting them the same rate that you did earlier in the week.
That's amazing. And do you want to talk a little bit about compensating factors when they are going in for these exceptions? What are considered some really strong compensating factors that they can bring to you?
Judy, that's a wonderful question. Nothing beats liquidity, right? Assets on hand is probably the best compensating factor you can ever bring to a table. So if there's an issue with low credit score, maybe a missed payment or two, liquidity is really the main thing that I think that can soothe a lot of issues. But again, it's always a balancing act, right? So especially if I want to say, hey, I could use 5% more in LTV for this particular product. Okay, well, why are you asking for 5% more, right? And what's the business decision that makes sense for us? So recently, let's say last month, we approved this loan. And again, this was a true kind of no can, we can exception. We gave a 5% LTV exception for an investor. And we gave that exception to them because they were doctors. They'd been in the business for about 10 years. They had recently spent a lot of their liquidity to buy a very nice primary residence in Texas, but they wanted to make an investment purchase, and I want to say it was Kauai. So they were a little tight on liquidity, but their income supported it very well, and we knew it wouldn't be but a matter of time till they were able to increase their liquidity position again and build their reserves. So we were able to make that LTV exception. So it's just kind of a balancing act. If it's liquidity is really one of the more greater equalizers, but professionals with longevity in employment, if they're in a more non-market risk type of job, or if they're small business owners that they've been shown to been in business for 15 years, they weathered a couple storms, but they have really good housing payment history. Those are the type of things that we're looking for, because at the end of the day, we need to know two things. One, are we going to get paid back, right? Does this person have the capacity to pay us back? The second question is, if they don't have the capacity to pay us back, how comfortable do we feel that we won't get a loss if we have to recoup this property? So those are the two main things that you're looking for. And if you can answer, one of those two questions when asking for an exception, reach out to us and let us know.
Awesome. Thank you so much for that answer, Brian. A wealth of knowledge. Thank you so much. We're about 2 minutes until the end of the hour here. So, and it looks like we don't have any more questions or comments. I've got some a request for your contact information, which I did put into the answer box for everyone. And then I will email that out to you, David Fuller. So thank you so much for your questions today. And with that being said, let's give a round of applause to Brian Ware and Finance Factors today, a wealth of knowledge. Thank you so much, Brian, for being with us today. Thank you.
Thank you guys so much for your time. Always a pleasure to be with Hamby. Thank you guys so much.
Awesome. And see you tomorrow at the chili cook-off.
See you tomorrow at the chili cook-off, everybody.
Bye, everybody. Bye-bye.